fake break before the mitigation of the POI, builds up liquidity, essentially leaves behind a trap. You could find yourself involved with lower time frame confirmation with the entry models we're going to discuss later on in the video. Well, the one entry model. Lovely stuff. The key thing to know. One sec, guys. Let me just text. Cool. Sorry about that. So let's grab a POI. So another thing, another sort of thing, smart money traders find themselves, find difficult when trading is sometimes when the market breaks a structure or gives confirmation, the price is already moved in the direction they anticipated it to. So just sort of to understand how the market really doesn't require structure to move. Since a move away from this POI, we don't get a violation of structure. It remains bearish in a smart money sense. Structure remains bearish. However, as algo traders, because we use liquidity, we don't need a break. We don't require this break in structure to signify momentum. However, we just use liquidity. We focus on what liquidity has been taken, well, how significant the liquidity is that has been taken, and how significant the liquidity is that's been built up. So we get a significant run on liquidity, a nice liquidity void. We're expecting price to deliver bullish. Say we have a higher time frame liquidity target that may exist up here somewhere. We build short-term liquidity for price to be attracted to, and we run liquidity in the opposite direction. Obviously, we trade away from the sweep. We sweep lower, so we want to buy and trade away from it. And we understand, price has generated significant liquidity. Structure never gets violated. However, this sort of level still plays as a beautiful buy, so we don't necessarily need structure. However, we may not need structure, but sometimes we will need momentum in the market, and that's when you can become involved in the market as such. An entry like this, where we have that momentum kick in, we can get involved off of a breaker block setup, which we'll discuss later on. Obviously, there's lots of rules around this, but momentum over structure. So, say price comes to your level, and we have very sort of big push up like this. Like this here. So we react very aggressively. However, we don't get that break of structure. That pause never happens. However, because price reacted very aggressively and kicked in momentum, we don't need this break structure, because this doesn't need to happen, because this is simply just built liquidity rather than breaking structure. Because if price had broke structure and then came down, this could have been a grab of liquidity. However, price doesn't break structure because it's trying to build liquidity here, which you can then get involved here on the lower time frame with anticipation of liquidity being taken out. Just a little bit on structure, structure traps. And so up, guys, so now we're going to be talking about imbalance in the market. So imbalance is one of the most important concepts in the market. Essentially, what an imbalance is, it's the variance at a particular price level between the number or magnitude of buy orders compared to sell orders. So at a particular point or particular price level, there's a large difference between the amount of buys compared to the amount of sells, or the amount of demand compared to the amount of sells, vice versa, in the market. And this will occur when there is an excess of either buy or sell orders in the market at a specific time. So an important thing to know about imbalances are that they are temporary, which means the market will like to reprice back into these levels to allow both buyers and sellers to get involved at this price level. Why would this happen? Well, during a sort of movement of price where it leaves behind imbalance, since there's a sort of variation between the number of buyers compared to sellers, vice versa, only one party is sort of happy to get involved there. So obviously when the market is pushing highly bullish, some traders are not wanting to buy because they feel like the price is too high or it's overbought, so they're not wanting to buy in. And obviously some traders are also not wanting to sell because obviously the market is moving aggressively higher, so they're in fear of being sort of caught on the wrong side of the market and trading to counter trend. So once an imbalance is created, the market will likely reprice back into that imbalance. And this imbalance is deemed the sort of fair value. Some people know it as a fair value gap. So this fair valued area is where both buyers and sellers are happy to sort of transact in the market, which can allow for sort of the accumulation of orders, since if both buyers and sellers are happy to get involved, then obviously the sort of total liquidity in the market is going to increase at this point, which is good on behalf of the algo, since it can generate liquidity and then move price into its next desired level. So as sort of the market sentiment increases, so like we just discussed, once sort of more traders are looking to get involved, when market sentiment is high, the algorithm is likely to move the market with low resistance. So meaning that once price is sort of filled an imbalance and perhaps taken liquidity at the same time, which is the sort of most high probability way, the sentiment for traders to be looking to buy and sell is high, since the price of the security is deemed well priced. So liquidity can easily be built up for the algorithm to then sort of propel the market to its next likely chosen direction. So like I said as well, imbalances are best when they're paired with liquidity and also time. So this ensures that the market has taken sufficient liquidity to use the imbalance to propel to the next market desired level. And also the time of the day is important. Why? Because we need to be in sort of the London, New York kill zone to know that the move is sort of high probability for the algorithm to inject large amounts of capital, since these are the most active sort of trading hours during the day and when sort of market volatility and liquidity is highest. So we're likely to see the sort of highest and biggest moves within the daily cycle during these times. So it's a little bit of information around imbalance. Obviously, what does an imbalance look like on the chart? Well, a lot of people, I assume, already know what this is. If you've got this course, you're already likely very familiar with sort of this style of trading you're trying to look up. So we're not going to touch on it too much, but essentially, for example, an imbalance in this situation of candles would occur between the low of the bottom of this candle and the high at the top of this candle. So within here, all of this gap here would be our imbalance in the market. So, obviously, like this is likely to form when we get sort of high momentum moves. So for example, just like this, like between here and here, we've now left behind a big imbalance. And I'm also sure that, on the higher time frame, if you was to look at this as like a buy to sell range, then between this low here, this high here would also be an imbalance. imbalance are likely areas for price to want to trade back into. So after this sort of push down like this, we understand that, price is going to want to reprice into this level before wanting to continue down. So since we've had this very bearish push, obviously it's not at a great it's not at a very well priced level. No one's looking to sell at the bottom here, and obviously traders aren't particularly interested in looking to buy since we've had a large move down in fear of being caught on the wrong side of the market. However, if price was to return into the imbalance, it will start to begin to allow traders to think, maybe it's better to sell here, and traders can start to get involved into the market. Obviously, from an algorithmic perspective, we understand that there's no liquidity inside this imbalance. So, we wouldn't sort of want to look for a trade on the sell here. However, we can spot we have some resting equal highs here. So we have resting buy side liquidity above these highs up here, which price may sort of be looking to come into. And obviously during this, it can come to fill imbalance. And when we also look up here, so let's just get rid of this for the time being. So when we look here, this was the sort of one of the most recent sort of price movements down. We've had a leg of price come down. We've had price sort of retrace here. We've had price retrace here, continue down again, retrace back again, continue down. Obviously, following sort of a bearish trend. You can see sort of signs of algo structure where liquidity is being taken out. However, obviously, this high here didn't actually take any liquidity. So if we were to just look at this as like a low like this, well, this high hasn't actually took anything here. So because it hasn't taken any liquidity, it's likely to sort of become a trap in terms of algo structure. So the next retracement could take this high and continue down. So this would make sense since obviously we've had a push down, a push up, a push down, a push up. So what does that look like? A push down, push up, and push up. And then we've continued down again here. It'd be likely to sort of come and raise some liquidity to continue down again. So we can sort of overall follow that algo structure, which we've sort of spoke about throughout the session, where price will continue to trap highs and lows and continue sort of faking out shifts and breaks in structure sort of upwards when that actually just sort of grabs on liquidity for the market to continue down. When we actually have a look at this recent push down, we can see that price has sort of formed an imbalance. So we have this candle here and in here. So obviously there's two different ways price can fill an imbalance. I'm just gonna get rid of this for the time being. So price can fill an imbalance partially. So as you can see in this example here, price has only partially filled this imbalance since the market hasn't came and filled the whole thing. So technically you could argue that between here and here, we still have this imbalance here which exists. This imbalance here now exists since this bit here has been filled. It's been filled up until this high. So, this sort of gap here still is unfilled. And obviously pairing this with our understanding of liquidity, this would make sense for the market to sort of maybe want to come into this area at some point to continue pushing down, as it's a well-priced level because it's filled imbalance. And also we know that we're subject to taking liquidity, and which obviously once the algorithm takes liquidity, it can use these highs, it can use them to transfer the money and to continue down, to keep putting in these bearish sort of structural lows. So you can also see that sort of prices, we sort of created a sort of market maker model here in a sense where we've sort of built liquidity to the downside, built liquidity to the upside. And obviously, as we discussed earlier, price will usually take one side and then trade it up to the other side. So this would make sense, in which we could then sort of take liquidity and continue down and put in our next sort of leg of price movement. So price has sort of partially filled this imbalance, and since obviously one, it had only partially filled the imbalance, and two, it did this push here didn't take any liquidity inside this push down, this sort of high is likely to be weak in a sense. So we could sort of deem this as a weak high. And also, you know, expect this remainder of the imbalance. So obviously we can see that between here and here is the imbalance. It was partially filled in here. However, it will be fully filled once we hit the top of this line here, this top line up here. This would be when this imbalance has been fully closing. Obviously, you can also see that we have, like say, we have resting imbalance technically up here where we've had this imbalance created. We've had this imbalance created between this low and this high, and it's been partially filled. However, since we've partially filled this imbalance, however, we've also taken lots of liquidity out. So since, although it's partially filled, the imbalance, we've taken lots of liquidity. So because we've taken a lot of liquidity, this high is likely to be strong, in which you can then see price comes and trades back into this level and fills the next imbalance, which gets sort of created in between here. This gets 100% filled or 100% mitigated. Prices are continue down. So we know this is a protected high since it's taken liquidity. And now we know that this price action here is efficient because this has been filled. However, this price action here isn't efficient, and also nor did it take any liquidity. This liquidity still exists here. So, you know, we could be under the influence that the market may want to push into this level, come in. Obviously, we have the strong rejection off of the level. So you can see that the market has wicked the level, and obviously a wick, you know, where the body doesn't close, the body of the candle doesn't close above the imbalance, has suggested that we've came to tap this imbalance and we've immediately tapped out of it, which is obviously good, a good sort of signal that the market is coming to reject this level and likely to want to continue to move away from it. And also, what do we know? The market moved into this level very aggressively. So once we have an aggressive move into a level which takes liquidity, we're likely to then get an aggressive move out of the level. And obviously, of course, aggressive moves leave behind fake demand zones like this. This is fake demand zone since we don't have any significant liquidity inside of here for the market to want to trade down into and continue up. So, you know, once we have hit a satisfying level for the algorithm and it's happy to sell off, where would our next liquidity point be? This low here. This would be our next target. We can see that inside of here, on the lower time frame, obviously we have this push above this sort of fake high that gets put in. And when we sort of look at this fake high, what does this high correspond to? Well, this high obviously corresponds to this demand zone here. However, since we've deemed this high weak here, obviously we'd also deem this high weak, meaning that any supply zone inside of here, so it could be this, you know, it could be this whole range here, any supply zone here, which you can see we're getting these minor reaction froms. So here and here, we would consider traps, you know, zones that are unlikely to play. So once we have seen, you know, this sort of rejection of this level and then a sweep on this liquidity, we know that there's been a sort of trapping from early sellers getting involved off of this level. And we've obviously aggressively rejected off of here. Following the lower time frame liquidity cycle, you know, we have taken liquidity. You know, what is the lower time frame liquidity cycle made up of? One is obviously taking liquidity, and the second is building liquidity for the market to take next. So obviously we've grabbed liquidity, we've built liquidity in the form of this sort of lower time frame trend line. And what has gone on the lower time frame, you can see that we've mitigated this candle. Or in other words, you can see that imbalance that lies on the lower time frame between this low here and this low here is traded back into it and filled. So we've now filled this imbalance here. So this is where we can sort of talk about the fact that imbalance is a fractal concept which occurs on all perspectives of time. So you can see it happening on the higher time frame up here getting filled, and also the lower time frame. And obviously once we've filled that imbalance, price has also taken liquidity in the form of these lower time frame relative equal highs. I'm going to zoom in so that's obvious. You can see we've got these group of highs here, 1, 2, 3, 4, getting swept and filling this imbalance in here. And obviously 2, even a part of this tiny liquidity cycle where we've taken this liquidity, we've also subsequently built liquidity. So the market is able to take liquidity and travel to its next chosen location. So you could potentially be a seller on the lower time frame inside of here. Where is our target? Target is this low. Obviously, depending on how you would sort of adapt your trading style, you may be able to get away with a smaller stop loss than this. Sort of a logical place to put your stop could potentially be above this high, since this high is this sort of OB candle range. Maybe you want to put your stop loss higher. I usually put my stop loss higher because I like to just cover sort of. Usually, one rule I actually do use is putting my stop loss above the sort of the bodies of the candles, since these are where the main orders lie in the sort of push. So hop onto the sort of higher time frame. Okay, so like 4, 5, 6, 7, 8. Okay, so it looks like this is the relative sort of high for that. So I like to just cover the bodies usually, just for probability, to keep me inside of the trade. Market begins to push down, and we now enter this trap level here. You can see we begin to get a little fake reaction out of that level here, and then we're going to come down to come lower. You can see that we have resting liquidity inside of these in the form of sort of lower time frame equal lows. And as we keep following price, on the lower time frame, you can see price coming up to take liquidity and fill imbalance inside of here. So this is not 100%, but partial fill of this imbalance. Ooh. Okay, so it looks like price wanted to come and fill that whole imbalance. And you can see as soon as we filled that whole imbalance there at this high here, we then can use that to continue down and eventually hit our targets. So, price, this is sort of a high resistance move down. Originally we had a nice push and then we sort of tailed off. However, this is starting to become late in the day, London close and then late New York session. So sort of lower volume at this period of time anyways. However, the trade idea played out perfectly. Came to hit TP, very nice. So we've talked quite a nice bit on imbalance there in the market. And we continue down to put in the next sort of leg of price action. Where we start to sort of build future liquidity points that price may want to trade into. So for example, like a level like this, where this is our internal range liquidity. This is our push down, our leg down, and then this is our internal range. Let's make this a little bit darker so you can see it more clearly. However, you can see that this high would mark the full clearance of the internal range liquidity. This may be a price level. You can see that price fills liquidity and then takes it out. So now we've taken a lot of liquidity, a lot of sell side. We may be looking to continue to push higher now. Trade back into sort of more sort of liquidity points. We can see that price in here came to clear this liquidity here. Also sort of built a lot of liquidity on the lower time frame, So we've got, our liquidity area with built up liquidity for the future. So this is obviously how the liquidity cycle operates, in which we can look onto the lower time frame. Price creating imbalance between here, there, and here. Trading back up to fill it, creating more imbalance in here. This would be the full. This is a partial fill. However, this partial fill is simply just a build up of liquidity that can get swept. And then we get the full fill here. The money is transferred and it can continue down. So you can see that sort of imbalance is a fractal concept occurring across all perspectives of time. And if we drop in here again, we can probably see the same thing occurring. So let's push up here. Let me just find the correct time frame for it. We're seeing here too, price coming to fill imbalance. So we have an imbalance between here and here. And as you can see, that this price imbalance never got tapped. So we never had this partial fill. Simply just built a lot of liquidity and left behind this imbalance for price to begin to come and fill. And obviously we get that 100% fill. If you're not already sort of aware from what we've been looking at, a 100% fill on imbalance is the most likely area for price to want to use as an inversion point. So as we sort of trade up into this level, once we get 100% filled, see we start to react and reject off of it and continue down. A part of the liquidity cycle, since we built significant liquidity, we trade up into a sort of repriced fair value area and we continue down to take out liquidity, just like up here too. Essentially, what is this? This is a inducement point for this order block here. I'm going to touch on this stuff more. However, if you were to drop down onto the lower time frame, you'd be able to see that this was just a higher time frame imbalance. So we can see this lower time frame, sorry. We can see this imbalance in here between this low in here, this low and this high. Come to fill this imbalance partially. Since this has been partially filled, we could expect price to come and fully fill it at some point. There you go. So price plays perfect into filling that 100%.